Okay, so I am on date night currently, and my date has left me to go look at the men's section. All right, we just so happen to walk into this Yonkers, and this Yonkers is actually going out of business. But I'm going to use this as a teachable moment to explain Fibonacci. Okay, you're going to have to put your visual cap on. So look at this, guys. You see tickets all over the store that say 20% off, 20% off, right? If you look at your Fibonacci retracement tool, it's got different types of, levels of retracing. So for instance, you've got, zero, like it has basically the market, if it made a move up, right, made a move up, if it's retraced zero, that means of that move up, it hasn't gone down. But if it retraces to 23%, that means it's gone down 23% of the way. So like it went up and it went down 23%. So a quarter of the way. It's gone down about a quarter of the way. That's the retracement. Then there's the 38% retracement, and then the 50. So now it's 50%. So it went up this way, but it's now gone down half of what it went up originally. All right. And then there's a 61.8. And then there's the other ones. All right. So we're going to start there. I want y'all to notice, like when you go into a store, I'm in Yonkers, and Yonkers, they're giving you that full-blown price. Everything's marked up, everything. I don't like to pay that price because I'm cheap, all right? Let me make sure I'm looking here. I don't like to pay that price because I'm cheap. So when I come to the store and I'm just picking a shirt, all right, let me just find one. If I come to the store, and this store has a price tag of $79, all right? 79 bucks, full price. Well, my cheap self says, I don't want to pay what everybody else is paying. I don't want to pay, 79 bucks. But if I knew that I had a special tool that said, hey, today is $79, but if you come back on Monday, it's going to be 25% off. All right? Then would you be like, I'm coming back on Monday, for real. But what if that tool also said, hey, you can come back Monday and get 25% off, but if you come back on Tuesday, you can get 38% off. What you gonna do? Oh, man, give me that 38%, for real. But what about if you knew that same tool said, hey, if you come back on Wednesday, 50% off. We'll give you 50%. You're really gonna be thinking like, oh, snap, that's good stuff, okay? But if you come back on Thursday, you can get 61.8% off the price of that $79 shirt that you love so much. So now here's the catch. You can come on Monday and get to 25%, but if you decide to wait for that 50% or that 38%, the people might have come and bought it all up. Maybe everybody thought that 20% was good enough and they just rushed the stores, pulled everything off the shelf. And so now when you're trying to wait for your 38% retracement, there's no shirts left, but maybe not. Maybe there's a bunch of people that bought it 20%, and then there's a lot of people saying, I'm going to wait till Tuesday. Let me get that 38%. So they waited, there's still clothes on the shelves Monday, right? Tuesday's 38% off day. So those people come in. You're risking, if you say, well, I only want to buy if it's 50% off, so I'm going to wait till Wednesday. You don't know if there's going to be anything left for you to buy, all right? You understand what I'm saying? So now, if you come back on Wednesday, you might just be able to get that 50%. And that might just be it. So that anybody who had 61.8% on their heart, anybody who's trying to wait out Thursday, the shelves are bare and there's nothing else. And basically they missed their opportunity to buy. You understand? So let me put that in perspective for you. Okay? So remember, you got the Fibonacci tool. All right? Basically, the tool is helping you know that this is the price. If you get no retracement at all, you're paying full price. You're going to pay $79 for that shirt today. But do know, if you choose to pay that full price and the market does choose to retrace, that means the moment you buy it, you're immediately losing value. That means you're in the negative. You're drawing down. And if you're going to try to sell it for a profit, it's going to be a lot harder for you to sell it for a profit. Understand? But if you wait, and you just say, look, I will only, entertain it if it gets to at least 38. That means you're going to wait till Tuesday. All right. You're that person that's waiting till Tuesday. But in the market, That's like, I will put my buy limit order at the 38% retracement, saying I will only buy it at this level. I don't want to buy price unless it gets to this level. That's what you're saying. That doesn't mean that it will, that, you know, people might come on Wednesday and be able to get 50%. So some people will be lucky. You know, I won't say luck, but some people will be, you know, if that waited patiently, if they wait till Wednesday, they'll get the full retracement. Yeah, the little 50%, they'll get 50%. Maybe you bought at 38%, but then that thing dropped in value some more. So those people came in and got it at 50%. So that means you're in drawdown. And the poor, unfortunate soul who bought that thing right at the very top paid $79. And now you got somebody who was able to pay half the price. And if that thing was able to turn around and go the other way, now those people who bought at 50% are happy, making a good, you know, making a good profit off of it. People who bought at 38% are happy. Eventually people who bought at the 20% will be happy. And then that poor, unfortunate soul might just be happy to break even when the market gets back up there. If it happens to go past that, that would be the high. That 79 was the high. If the market so happens to go above that, and now the value of that shirt is now $100, then they made a little profit. But everybody who bought at 50% made even more profit. Anybody bought at 38% made more profit than the poor, unfortunate soul who bought the $79 shirt for full price. So that's like a, you know, analogy to how you use Fibonacci. That's not how you apply the tool, but that's to help you understand why you apply the tool and how you can use that tool to get you the best entries. To get you, you're not always going to get what you want. Like the same poor people that said, oh, I want to wait till Thursday when the market retraces to 61.8, when I can get a 61.8% discount on that shirt, because people who were buying at 20 and 30 and 50 bought up all the merchandise. So there's nothing for anybody who is waiting for 61.8 or lower. Does that make sense? And this is how I look at it. If I'm getting 75%, now that's nice, but nobody, like, who's going to get something for 100% off? That means that thing has absolutely no value, and most likely it's going to continue to decrease in value. So for me, I don't like to trade anything or buy anything after it goes past the 61.8. That's just me. There are people that like, you know, getting 70% off and 80% off. But me, I feel like that thing is so, you know, the value of it is so low that perhaps it's not going to have any value anymore. That's Adaeza's take on it. That does not mean that's what it is. All right. But now you have a good idea of how to think about Fibonacci as far as, you know, when you're looking to buy, put a buy in, and instead of paying at full price when the market's at its ultimate high, you don't want to buy at the high. You want to wait till that thing starts to turn, starts to drop in value. And then you use the tool to figure out, where would I buy? So those levels, instead of them being 23 and the 50 and the 38, those, think of those as days. So on this day, I can get 25% off. On that day, I can get 38% off and such and such. All right, that's it. I'm stopping now. I'll make a video that shows actually how to actually use the tool. All right, hope this was helpful. Okay, bye-bye, guys.
Hey, everyone. How's it going? I hope you guys were able to get some value out of that analogy. That analogy is actually available. It's on YouTube. I put it on YouTube. I was in the store, and I just so happened to be in poor old Yonkers, because, you know, Yonkers is no longer in business. And the idea came to me. I have gotten so much value out of that amazing tool called Fibonacci. What's really happening right now? Yeah, I've gotten a lot of value out of the Fibonacci tool. And so now I want to show you guys how you can apply it, how you can use it as well. All right. So that analogy, I hope that helped you guys. I hope that, you know, some of you who are visual learners, we're able to visualize the analogy. Now we're going to put it on the charts and we're going to apply it. How's everybody doing today? Everybody good? How is everyone today, tonight? You like that analogy? Oh, absolutely. I will put it in the Facebook group. All right. I'll make sure I stick it right on in there. Hi there, Bobbiette. How are you today? Sorry, that's my sister. Say hi to my sister, everybody. Yeah. Okay, good. You guys like that analogy? Fantastic. Let's go ahead to Trading View. Man. So if you guys were here for the last session when I broke down market structure for you, Ready to learn? Excellent. So if you were here when I broke down market structure, then you're going to like this tool, because from that last training, we know now that the trend is our friend, right? You say, hey, sis, the trend is your friend, right? We want to be in a active trend, not a dying trend. We want to leave the trend when it's dying. Last session, if you're new and you didn't get to see it, you'll want to go back and watch it. I talked about how to know when a trend is dying, how to know when you should abandon the ship. We only want to trade trending markets. At least, the type of trader that I am, I like trending markets. The good news is the market is always trending depending on the time frame that you want. So you can trade, it might not be trending on the 4 hour, but it's trending on the 1 hour, or it might not be trending on the 1 hour, but it's trending on the 15-minute. There's always a trend happening, and the rules that we're going to talk about will apply. All right, so let's just Google, let's see here. What pair would you guys like to, let's see, what's a good trending pair right now? Let's look at XAU USD. I don't know why I decided to go with gold. Go for gold. See what happens. All right, so what I want to show you, oh yes, you see this was our dying trend right here. This was our dying trend. You see that? Like just kind of reviewing yesterday, or not yesterday, Monday. Let's do a quick review. UJ, it's your first time here. Excellent. I'm going to make this dark, guys. I like dark and lovely. How's that sound? Night warrior. Woo. All right. So, all right. You guys see this? Hold on. Let me turn off my thingy-mabobs. Okay, so this was our trend. You see that? It was going down. Very clear down trend, right? Making highs and lows. I definitely said that this was the real low. This was not a real low. This was the real low. All right. And now it looks as though gold has made our higher low. Remember, our no lower low has happened here. This was the last area. It has broken that. And so now we're looking to see, it's definitely made a new lower low. So gold is definitely looking like it wants to be bullish. It is looking like it wants to go for the bear, or for the bulls. That's what it's looking like. Now, I want to tell you guys right now, I'm not saying that gold is bullish, but I am saying that it looks bullish. What I am saying to you guys is right now in this particular market, this is known, oh, okay, let me actually use a color y'all can see. This market is known as a sideways market. Okay, you see that? It's moving sideways. It's going down, and it's going up, and now it's going down. It's not really going anywhere. It has not broken above this high yet. So this is a sideways market. It is not progressing, all right? This is not the market to use Fibonacci. We don't use Fibonacci. The only way that you would use Fibonacci, you'd have to understand that this is all one area. All of this is all one area. All right? You don't want to use Fibonacci on something like this. You want to use it on a trending market, a healthy trending market. So like these are great. This is a trending, actively trending market. Everybody understand that? We do not like consolidation. All right? Not for Fibonacci. You're not getting jack with that, okay? All right? You will get chopped up. You will get your feelings hurt. You will get, it will be a very painful experience for you. All right? So now, I want to talk to you about it. Like, remember how, in our PowerPoint, we were talking about, okay, you got a trending market. If the market is making higher lows and lower highs, we got an actively trending market. You want to buy the dips and sell the highs, right? So in a downtrend, you sell highs. So this would be considered a high. This is considered a high. This is not yet considered a high, not until it starts to do something like that. All right. Now it's like, this could be a possible high. All right. So we want to know, how far can the market pull back? How far can it pull back? Like, how do we know what's the best place for us to get in? A lot of times when the market is made its move down and then it's starting to pull back, people are doing all kinds of stuff right here. Some people are buying like hotcakes. Oh yeah, let me buy, buy, buy. Others are selling like hotcakes. Ooh, let me sell, sell, sell. The issue is you don't know how far up it can pull back. You also, if you're a buyer in a downtrend, which is a very risky way to trade, it's called counter trend trading. You also don't know when the buy train is over. It can turn at any time. All right? There's a technique to doing it, but right now I want to focus on those that want to go with the trend, okay? So I'm going to show you using my amazing, beautiful drawings, okay? Because I'm such an amazing, beautiful artist, right? All right. We have a downtrend, all right? In a downtrend, markets swing down, right? And then they are going to swing up until the market starts to do anything. Like it needs to start to show the pivot. It needs to show it. Like that is the part. This is a good sign that, all right, the market is looking like it's ready to turn right here, okay? This is not a good sign. Does everybody understand me when I say that? A is good, B is bad. All right, and this is B. Does everybody understand what I'm saying? Okay? A is good, B is bad. Why is A good? A is good because the market is showing that it wants to turn. B is bad. Why? Because it could continue down. You don't know. A could also continue down, but at least you're getting the turn. You're starting to see the market slow, okay? So that's kind of like a key. You wait, one, when the market is trending, you want to wait for the slow. You want to wait for it to slow. Wait for it to slow. Let me make sure I put it so y'all can see. All right? So this is like our first rule. A is good because it's starting to slow. B, it's not slowing yet. It could be going forever. All right? Usually when we see that, let's go look at it over here. All right? You see how the market had this nice waterfall of candles like right here? It went down. And then this area right here is the slow. Does that make sense? This area is the slow. Like it's making big, fat, juicy candlesticks. And then all of a sudden, nothing, nothing, nothing. This is your sign that might be my bottom. Okay? Might be. Might just be. All right? And then it slows. It pulls back. This whole thing. And I'm going to show you how you look at it. All of this from this lowest low to the highest high. So this is our lowest low right here. Okay, let me get my drawer. This is the low to the highest high. All of that is a pullback. Let me erase it. So I'll show you the swing high. We draw, like the wicks are very important. So here is a wick. This is the highest high. This is the lowest low. Everybody understand why? Because of the wicks. From wick to wick. This is a low to the high. Then we swing all the way down to the lowest low, right here. That is where we were put our fibs, okay? Now the issue is, and I'm going to show you, the issue is sometimes you don't know. Like maybe, like what if, you know, that was the low for the time. Like this is the low. When you're drawing your fibs, you treat this as though it's the low. Right here. Okay, that's our new low. Until the market makes a lower one. And then you adjust it. You adjust that along with your fibs. You adjust your fibs. I'm going to show you how to do that. Here comes another one. Okay, see right now that could have been our actual low. We don't know. Oh, look, that thing is even lower. We would adjust our fibs even more. All right? And now we're doing our move. Everybody see how I would adjust it based off wicks. So remember, number one, when drawing fibs, okay, you always want to wait. Always wait for the market to come, basically to slow down. to slow down. Our slow down looks like how I showed you. Like this right here, it was going down, going down, going down. Then all of a sudden, this thing right here, this right here was an actual turn. Slow down or even slightly turn. This is definitely a turn. This is definitely something you would have wanted to put your fibs on right here. All right, I'm going to show you how to actually draw it. So let's go ahead and draw it real quick. Yes. Let's draw it. You always want to draw from high to low. That's number 2. Or low to high, depending on which direction. You always draw left to right, high to low, or low to high. All right? Always draw from high to low. Or excuse me, we'll go with left to right. If you draw from left to right, then you'll figure out if it's high to low or low to high, okay? Just like you read a book, as far as in English, when you read a book, English, Spanish, you're going to be looking from left to right, right? So let's go get our Fibonacci retracement tool. This is our high, all right? You draw from left to right. So obviously in a downtrend, you're definitely drawing from low or from high to low. High to our low. Let me change the color so y'all can see it. Okay? See how I drew that? From this high, from the tip of that wick. From that high to that low. Okay? Did everybody see how I drew that? I drew it from the high to the low. If I'm in a downtrend, everything is always left to right. Always left to right. If you remember left to right, it will be a lot easier for you to draw stuff. We all good on that. Okay? So now, let's just say that now this is where market is. And let me show you what the adjustment process looks like, because you got to be very flexible when you are trading. So if I see a big momentum move like that, and then all of a sudden, oh, look, there's a wick. Okay, well, I'm waiting for my next wick to show. Oh, look, that one's even lower. I see how I'm adjusting my fibs. All right, perhaps this is the turn. Now, the key is, as I was showing you in the analogy that we're talking about is the Fibonacci tool is like your best friend that works at that one store that can give you a discount. And they can tell you which areas the discount would apply. Like they can say, if you come back on Monday, then I can give you a 23% discount. If you are willing to wait until Tuesday, then I can give you a 38% discount. If you come back on Wednesday, we got you at that 50%. Or Thursday, we can even do 60. All right, 61.8. So I'll write down the dates out here. Something like that. All right, let me try to write them out for you. So Monday, Tuesday, Wednesday. Okay. See? Tuesday, T for Tuesday. All right, W for Wednesday. And this is Thursday, all right? Now, here's the thing. You guys know, we've all been Black Friday shopping, right? Some of us. We've all gone Black Friday shopping, or we've all anticipated a sale, or we know someone who's gone Black Friday shopping and have heard stories, or we watched the internet, okay? Some of us have had some form of contact with a crazy sell, all right? Now, here's the thing. What we know is if you wait too many days after a sell has gone on, what happens, guys? Is there a lot of merchandise left? It really does depend. But if you wait, like let's say Black Friday is today, well, on Friday, okay, whatever. Black Friday is, today, and then you decide to wait 5 days to go there. What's gonna happen to all the merchandise? Are you gonna have the pick of the litter, or is it gonna be slim picking if you choose to wait? Let me know. We're going to have the pick of the litter, or is it going to be slim pickings? Okay, there you go. That's that RSI, yeah. It's gonna be slim pickings, right, guys? It'll be slim pickings. Okay? That is what this is doing. So here's the thing. When, like, I'm using that analogy so you guys understand that each of these are levels. Nobody knows, like there are some things that sell out like hotcakes, like TVs, you know, during Black Friday, TVs go nuts. Like any type of game systems, like people are fighting each other over these game systems. Now, if I had an entire, I don't know, box full of I don't know, cotton Q-tips, I don't think that the Q-tips are going to sell as much. You might have a whole lot of merchandise left even after days and days. Some things will go very quick. Some things will go very, very, slow. You really just don't know. You don't know. So what this is telling you is, how long are you willing to wait? Maybe you're like, I don't care about that first initial run through. I'll come later. Like, I don't mind. I'm willing to buy, or shall I say, I'm willing to grab that merchandise right around this time at that 50%. I don't care what happens here. I don't care if all of a sudden the market comes right here and then it drops 500 pips. It does not matter to me. I'm only interested once it gets past 50%. I'm only interested after I can get a 50% discount. That's what you're saying. Because remember, in a downtrend is only a downtrend, a healthy one, and it's constantly making new lows. So your goal is to try to get, that merchandise at the best discount possible. If you can buy way deep up in here and it drops 500 pips, you're better than the person that bought way right, like what up here. Does that make sense? If you can get that thing right here, nobody wants to buy right here, because now that person, whoever bought right there at the tip of this little bend, is going to be feeling some kind of way, because now they bought and is losing value. Just like everybody who bought up all those Bitcoins, and the Bitcoins has been falling and falling and falling and falling ever since. Now those people who are caught at the very top of this peak and they bought way up here are feeling really bad about themselves and their life and their choices in their life, because they bought way up here and now Bitcoin is way down here, and they could have bought it way down here for a much better discount and been in a much better situation for when it does turn. Does that make sense? That is what the Fibonacci tool does, is it gives you a good place to say, yes, okay, if I'm going to buy, that's where I'm going to buy. If I'm going to sell, that's where I'm going to sell. Does that make sense to you guys? I'm trying to tell you, the people who bought Bitcoin way up here are, it's going to be really hard for them to make eye contact with their spouses and whatnot. It's probably really hard. I'm sure some of them got divorces over all of this because Bitcoin has fallen so hard, And I want to show you something, like the beauty of this tool. Like right now, we don't know. You don't know. I don't know how deep can this thing retrace. Nobody knows. No one knows. What I do know is that I can make a plan around Fibonacci. I can make a plan around Fibonacci. I don't get to plan out the crystal ball. I don't know what's going to happen, but I can say that I am only interested in trades that are 50% or deeper, right? That's because maybe if you're going to put your stop above this high up here, why would you want to sell way down here? That means, and let me kind of erase this so it's prettier again. Okay? If you're going to put your stop loss up here, right? Everything's black. If you're going to put your stop loss up here above this high, this is the high. If you're going to put your stop loss up here, does it make sense to sell way down here? Let me know. Does it make sense to sell right here, even though your stop loss is going to be way up there? Does it make sense to sell right here? Heck no, it doesn't make no sense. It might make more sense to start selling at least at 50% minimum, right? Do you see how this risk gap is getting you know, shorter and shorter. If I sold here at the 50%, the market can still move all the way up here and still turn around. All right. So maybe I say I don't want it at 50%. I want it at least 61.8%. I'm willing to sell there. All right. That means, okay, see, my gap has gotten smaller. All right. But what if I say I don't want to wait till 61? I really want a very low risk opportunity. So I would only be willing to sell if it comes here. Now you see how my risk gap has closed quite a bit. Now the big issue is what if it doesn't reach up here? Let's look and see what happens. Okay. So if you decided to get in at 50%, so far you would have been activated, right? Well, let's see. Does it go any further? It doesn't go any further. Oh, it just kept on falling. Maybe. Yep. It's going down. Boom, it's down. So that means if you decided to get in at that 50% level, you would have been activated. But if you waited to 61, you didn't get activated. If you waited to 78, you didn't get activated. Aw, that's the risk you take. I mean, it's not a bad risk, guys. I learned from somebody who I find very, very credible. They are an 8-figure trader, and they said to not be trading is to have money in your account. All right? To not be trading is to have money in your account. So a lot of us feel really bad if we miss that overall move. To not be trading is to have money in your account. If you didn't get into this trade, you still have money in your account. You know what I mean? Are you taking advantage of the amazing, pit party happening right here? No. But you still have another opportunity to get in on the next pit party, as Lee would call it. All right? Why do they call 61.8 the golden zone? That's a whole nother training for another time. But it's basically because, every all the things and it's a nice it's a mouthful. Like all of the numbers, like you've got 5 fingers on your hand and 1 hand, like the ratio from your hands to the fingers on your hands and the digits on your fingers. If you start dividing them, they all come back to this 62% ratio. All things around the world, like even like if you look at a hurricane, just the measurements of a hurricane, there's all kinds of things all in life where if you divide the ratio out, it comes down to 61.8. Somewhere around 61.8, like 62, 61, somewhere within that. They call it the golden ratio. Like they look at the flowers on a petal. Yeah, did I say that right? The petals on a flower. However many of those versus the leaves. If they divide them, it always turns back into that 61. So they felt like nature shows that, they respect this ratio. I wonder if the charts respect this ratio, and apparently it does. Okay? Does that make good sense? Okay. So I just want you guys to know that's one. We just talked about how do you apply the Fibonacci. All right. 1, you apply it because when we talk about trading plans, we're always talking about trading plans. Like you need to say, this is what I do in the market. You're an investor. This is what I do. You don't just come in here and say, is there a trade available today? Let me take it. That's not how you do it. You have a specific plan. That means if you're trading a trend and you see that the market has turned like so, like it did right here, we have a high, we have a low. I only take trades at the 50% and above. That is where that's the only time I'm interested. All right. So let's go look at this next one. All right. You see, this is our new high. Everybody understand that this is our new high, right? The thing has gone up high and now we're going down low. So I'm going to start off my fib tool here. It could go lower, and that's why we're going to adjust it as necessary. Yeah, like it just did. See that? Okay, we're still going low. Oh, we're still going low. Okay, we're still going low. We're just going to let this thing go. Okay. Like you don't actually use this tool until you see the turn. Boom. This is the beginning of our turn. And now, again, I am saying, okay, where do I want to get in? The only places that I am interested, like I'm not interested until it's at the 50%. All right. And it changes with every pair. Like when I traded Ripple, I would be interested at 38% because it was so strong. The momentum was so strong that it never made it past 38%. You know, and then you got some pairs that have very deep retracements. You learn those pairs. But I'm just gonna say I'm not gonna get in unless we get that 50%, baby. All right. Okay, so in this situation, it either wasn't finished. I don't think that was finished. What do you guys think? Look at that. Do you think that this was finished? Does it look like the momentum has stopped? Like just using your eyeballs. Does this look like the momentum has stopped? The reason I'm asking you this is because this is what you have to do in the markets by yourself without me being there. Yes, you actively follow a trade. Very good, Kyle. Very good. Nature's perfect number. Yes. You actively are following the trade. When you are looking, when you're stalking a trade, that's why it's so hard. It's so hard to trade multiple things because you have to actively follow certain trades that look like they might be ready. Like this right here, I love seeing trades like this. That means, you know, this can't go down forever. It's going to have to slow down at some point. Although this is some serious drippage, you know. So let's let it go. Okay. Maybe this is the next turn. Maybe this is the real turn. Okay. Boom. Maybe this is it. A lot of momentum going down. Hello. Hello, exactly. It's closing lower. It's closing lower. Not to mention, look, yeah, this thing came down and then it turned and then it dropped some more. But this was more like a pause. You know what I mean? This is like I ran 2 miles and I caught my breath and I'm ready to run 2 more miles. Okay? This is not I ran 2 miles and I'm totally done now. Let the market retrace. Now let's see what this one is. We really only know if it up. We're just not done. Good Lord. It's just not done. Not done. Okay. Maybe this is the turn. Yep. This is the turn. Okay. So 23%. Some of us are like, I'm getting in. Woohoo. Okay. They get in right here, setting their stop above the high. Maybe they set their stop above this high. Let's see if that was a good idea. We're only interested, okay, 38% people are activated now, okay? If I was sticking with my 50%, I didn't get in this trade. Is that a bad thing, guys? Tell me, is it a bad thing? Is it a bad thing? Like, so I would have got in at that 38, 50, I would not have been activated. If my trading plan says, Adaeza, you only take trades at 50 and below or and above, that means 50 and deeper. Is it a bad thing that I did not get put in that trade? Let me know in the chat. Tell me, guys. You said someone made the right decision and made money. It's not a bad thing. Why? Why is it not a bad thing? Exactly. You didn't lose either. To not be trading is to have money in your account. There will be another trade. See, I made money on this one up here above. I made money up there. I did not get to be in the pip train down here. All right? You're just going to have to let those people celebrate, you know, in the chat rooms and just be happy for them. Don't be bitter because you didn't get to be in that party. All right? It's okay. Now, here's another one. This is our low right here. This is our high right here. Because this is a downtrend, we are only interested in catching the moves down. Okay? Because some of you are like, well, can I draw Fibonacci on this, like from this low to this high? Can I draw Fibonacci here? Can I go from like, you know, from high to low? Can I do that? No, because you're not like, remember, when you're going in a downtrend, the tool is a retracement tool. All right? It's a retracement tool. This is the retracement. all right? Also known as the correction. It is measuring the correction. This is the impulse. That the Fibonacci does not measure that, okay? So I wanted to make sure you guys understand that. People get all, funny about Fibonacci. If you're in a downtrend, you are measuring the pullbacks, also known as the corrections, when the market is correcting itself, all right? So usually it gets all ugly and jiggy-jaggy and ziggy-zaggy. That's what it looks like. The impulse moves are like deep and full of momentum. Like this is a very impulsive move. Do you see how they're all one color, really? They're pretty much all one color. Do you see how ugly this is? Like it's, there's a sprinkle and sprankle of all different colors and it's not really doing anything. This is a correction by any other, like, oh my God, this is just a perfect example of a correction. Another perfect example of a correction, followed by impulse moves. Impulse moves, all strong, all one color, very, very strong. Everybody understand me when I say that? Everybody understand when I say that? The Fibonacci retracement tool is measuring these. Basically, it's measuring the ugly stuff. It's measuring, see, like this right here. Impulsive, very impulsive, lots of strong purple candles. Yes, there's a blue one, but there's way more purple ones, and they are meaning business. All right? Understand? Now this, you would have got your feelings hurt. If you tried to draw Fibonacci on that, you would have got your feelings hurt. That is why you can only use it in trending markets. All right? Yes, also a flag. Yes, people like to use Fibonacci in measuring flags. They like to use it. Okay, so let me go to a different market. Let's go to Euro USD. All right, someone said UJ. USD JPY. Anything uptrending? I want to show you guys what it looks like to do an uptrend as well. Okay, we'll go with this little piece right here. Let's go with this piece. So, how do you ride the trend? How do you ride the trend? All right, remember, left to right. So in this situation, this is the lowest low. I don't know why that thing is skipping around like that. This is our lowest low. This is our highest high. Oh, would you look at that? If Adaeza was using her trading plan, I would have been activated into the trade. Because 50%, baby. See that? I would be in the trade for sure. You can say, you can have very specific rules where you're like, all right, I will only get in at the 50%. I'm not interested in looking until I get me a 50% discount because I'm cheap and I like my discounts. All right. And then you can say, if I get in at the 50%, I'm going to set my stop at the 88%. And that just is how you handle it forever. Like you don't want to see price retrace all the way back to 100%. Not in a healthy uptrend, right? You don't want to see price retrace all the way back here. All right. But it does. It can and it does. But if I get in at 50% and I put my stop at the 88, my risk is not as bad as if I decided to get in right up here. Okay? If I decided, let me buy right here, then that means I am now in drawdown about, just good 119 pips. We know that price has all of this area to go down before it's not valid anymore. Right? So why would you want to get in so far up? You want to cut this drawdown. Let me show you. I call this the validation point. All right? Trade not valid. Honestly, to be 100% honest, this is your trade validation point. Let me explain that. When I say trade validation point, I'm saying that price can go from here all the way to the end of this box before it's no longer valid. Does everybody understand when I say trade validation point? Anything from here to there, from this top of the purple box to that bottom of the purple box, anything from those two areas, it is all fair game. The trade can go anywhere. It can do all of this. It can come all the way down here and still turn around and still turn around and still go high and still be a uptrend. If you guys watched me talk about market structure, you see that this is only, this is only valid, like, what's the word I'm looking for? It only broke one trend validation things, which was it did not make a newer high. It came all the way back down here. It was not progressing, but it did not break any lows. So therefore, price can come all the way down here and still turn around. So that's why a lot of times you'll see people say, okay, set your stop above the last high. They set their stop above this high right here, or excuse me, in this situation, this low, because according to our trending rules, if we break this low, that is a sign that our trend is breaking down. Okay? That's a sign that our trend is breaking down. All right? Now, I don't have to go through that. Like, I can say, yeah, this is our trade validation point, but as far as Adaeza is concerned, I'm only willing to wait out to this 88% area. So I'm only willing to get in. This is my activation area. This is the area that I will get out. You need to make sure you have all of that ready to go before you get into a trade. Okay? Looks like purple is bull. Yeah. All right, so let's see. Price has come all the way down to our 50. Is it going any lower? It went higher. Yeah, baby. I'm happy. Happy camper. Okay? Boom. So price has gone up higher. So we wait. We wait to see price come to an end and do a little turn. And then we do it all over again. Here is our dip. See that? And this is our new possible high. Okay? And remember, 50% or higher is all I'm interested in. So if I get in at the 50 and I say I'll set my stop at that right there, I'm just using that as an example. You guys absolutely have to set your own rules. And it depends on the pair. Like USDJPY could be a very deep pullback type of pair, or it could be a very shallow. Or if the trend is brand new, it might be strong momentum and it only pulls back to the 38 and then it keeps going. You never know. All right? But look at that. I never got into the trade. Everybody else is celebrating their pit party except me. I didn't get put in it yet, guys. Okay, because this was our high. So I missed out. That sucks. But I was able to take advantage of one. Okay, look. We have a turn. Do you see the turn? See the turn? Let's do it again. Okay. From here, you go to the origination of the move. This is where it originated. This is where the turn. So our low to our high. And remember, this is back testing at its finest. Is 50% the best point for me? Apparently not. Not for a new trend. Not for a brand new fresh trend. Okay, I guess I ain't getting. Oh, we're still going down. Okay, look at that. Oh, and on top of that, we have to adjust our fibs. We have to adjust our fibs a little bit. Let's see what happens. It went down to the 38% and it kept on going. Man, maybe I need to change my trading plan to 38%. Okay, we have a new. It's time to readjust it again. Here's our low. Here's our high. Ooh-wee. If I got in at that 50%, I would for sure be in this trade. All right, if my stop was right here, I am in the trade. In fact, I was a little bit negative for a little while, but now we're good. And now, ooh, that thing just barely, is it touching it? It's either it's touched me or it hasn't. Oh yeah, I'm dead. Not to mention, it broke this low. But it hasn't closed below it. It can still turn around. Ooh, it did 100% retracement on you. Is it going to go higher? Yep, it did. Look at that, guys. You see that? See how it did? Like, this was our low. It did pretty much a 100%, but it never closed. But there would have been a lot of people who would have lost on this one because all those wicks. All right. So using this Fibonacci tool, it tells you places where you can get in, where you could get in. All right. Does it work every single time? No. In this situation, you actually had a full retracement. price did not close below this low. Had it closed below, this trend would have been dead. All right, but it still turned around. And we do the same thing all over again. You just keep on reapplying it from the low to the high once you get a turn. Okay? 61, is it going to turn? Who knows? It's turning. I'll tell you right now, this is why I absolutely hate trading USDJPY. It looks like, oh, it's pretty much dead. This thing has, this is definitely the sign of a dying trend. It has died. See that? It broke this low, didn't make a new high, and it made a new lower low. This trend is done. All right. Does that make sense to you guys? 920. 920. Let's try a different pair. Once price starts to move sideways, you see how hard it was to use this thing in a sideways market? It is really hard because this is pretty sideways. Really hard to use Fibonacci in a sideways market. It never works. But in a market like this with momentum, that's when you want to use fibs. Let's go look at that one. This right here, oh man, this is a Fibonacci dreamboat. Let me go to the 4 hour, because then you can get much better. Okay. Paradise. All right. GU. Yes, kaput. Yes. Okay. So let's say, so right now, again, it's hard to apply it at the beginning of a new trend. Like right here is kind of a new trend. But once you start to see, okay, price has really broken out. You see how this was like it was a lower low, lower low, a no lower low. It broke this thing, created a new. This is where you want to start applying it now, okay? Because anywhere else, you're going to be risking a sideways moving market, all right? It's risky anyway, nonetheless. So here it is. You've got this low to that high. It pulled back to the 61, did a little sideways cha-cha-cha for a little while, and then it took off. If you were applying that same situation of I need to get in at the 50 and nothing greater or nothing less than that, and I'll put my stops here, this would have been a winning trade for you. Okay? Here we go. Here's another one. You go from the low to the high. Somebody wanted me to go to GU. All right. So, same thing. If I get in at 50, stop at the 88. I'm just giving you an example. This would have been another winning trade for you. All right? I'm thinking you guys are getting the hang of it. You see how I'm applying it? Does anybody have any particular questions about how I'm applying Fibonacci to the screen? This one right here would have been one of those ones where you would have lost if you used it, but the trend would not have been dead. It was just 100% retracement. Where would you put your take profit? Good question. I like to put, like, your first take profit should always be at the next high. So for instance, if I was, trying to get on this one, let me go back. I'll give this one as an example because it's just perfect. All right. So if I was to say, like, okay, this is my low, this is my high, your first take profit is going to be at the high right here at this line. This would be where you take your first profit, or at least move your stop loss and all that stuff up right here, because using the rules of a trending market, right? When you're going up, there are two things that need to happen. One, the market needs to be making higher lows, right? but it also needs to be surpassing the highs. So this right here is a safe place to take your profit, right up here at the high, because there's no guarantees that it will surpass it. That's why we have that thing called the no higher high. So, you know, a lot of times price might come right up to it, forming like a double top, like so. But nonetheless, you could take profits right there. Does that make sense? This, if I was trying to get in here, I bought here, this would be my take profit area right there. Okay? I am saying, well, yeah, I'm giving an example when I say stop losses at the 88%. You totally, like, it changes per pair. You kind of have to study the pair and see, all right, does this pair tend to do more deep retracements than, you know, than others? Like, does this pair tend to retrace 100% of the way like it did just now? Like, you know, this one's not the 100%. But you see how if you would have taken your profit here, you would have had your profit for sure. And then all of a sudden, pew, pretty much 100% retracement of this move. Okay. 100% retracement of this move. See that? Price came all the way up here and then came all the way back down here. This is a pretty much 100% move, but because it did not close below the 100%, the trade could still turn around, and I believe it did. See that? Boom. Isn't that something? Let's do another. You go from this low to this high. Already it has, see that wick? That wick matters. It came all the way down to this area. Now, if I'm saying I only want it at the 38 or I'm not interested, so I might get in at the 50, I might take profit right up here. That might be my take profit region, or at least my first take profit. I might take half of my money off right there. Okay? Does it go lower? It does. Wait, hold on a second. Nope, it did not go lower. So I wouldn't have gotten in on that. I would have won the last two trades. I just wouldn't have gotten in on the next trade. Everybody understand? Okay. Are you using pinning orders? Yeah, you could totally use pinning orders. You could definitely use a pinning order to get in. Say you're like, let's say you're interested. You can do one of two things. You can say, if I only like it at the 50, and I'll set my stop at the 88, then you can do an entire pinning order with everything ready, set, go. If you're like, okay, it's at the 50, now I'm going to watch it. I'm going to watch it now to see what it does. I'm going to watch it to see if it goes any lower. I'm going to watch it to look for the pause, because there's usually a pause of some sort. Then maybe I'll get in. Does that make sense? So you can do this from an active roll and a passive roll. The moment you see a turn, that's when you watch it. The way I like to trade these is I do active watching. If I'm awake, I'm actively watching it. I'm saying to myself, all right, we're at that, you know, okay, 50 is good. We're there. All right, let's see. But it looks like it's real strong. Like if I see big, juicy candlesticks like that in my 50% area, I'm going to expect that it's going to go down lower. Okay? But if I start to see candles running out of gas, like, you know, like these small ones running out of gas, these little small ones, and I'm at the 50, then I'm going to be paying more attention. Like, okay, perhaps this is a good time to look for an entry. Okay? So let's see here. Where would you put a stop loss? Oh, excuse me. I'm just giving you an example. It doesn't have to be, you know, stop loss at the 88%. It could be a stop loss at the 100%. It could be that you don't take a trade unless it's at the 61, and then I put my stop loss at the 100%, which is pretty much below the high or the low. All right? It depends and it varies. It might be that you trade an aggressive pair and you don't get in until it at least gets to 38%. All right? You have to know the pair. Some pairs have really, really deep, like deep retracement. So it's going up and then it just does one of these moves and then it goes up. Okay? And then you have the little shallow ones. A lot of momentum. They just keep popping up like that. All right? Give you a 23 and a 38 retracement. Does that make sense? Thank you so much, B. Simpkins. Appreciate that. That's how you roll with these right chunk. Okay? That's how you use Fibonacci. I love it because Fibonacci keeps me from getting into a trade too soon. When I get in my feelings, let's go look at Bitcoin real quick. The BTC USD RESPECT. All right, look at this, guys. You can apply Fibonacci on any time frame. If you guys understood Fibonacci, then you would understand that it was absolutely the dumbest thing ever to buy up here. You would understand that. Why? Let's talk about it. Look at this, guys. Remember, when you're buying Fibonacci, what did I tell you to do? You wait for the turn. Like right here, everybody and their mom was trying to get on this thing. Anybody who bought up here, now they are feeling some kind of way. Their marriage has probably fallen apart. No, I'm just kidding. It depends on how much they spent on it. You know what I mean? Like they are feeling horrible about themselves and life in general. Okay? It is now. This is the time. It's at this time that you should be interested in not selling anything. But now it's like, okay, I'm waiting till at least the 50% mark. At least. So let's watch it. Let's watch it do what it does. Okay, it's gone all the way down to 61.8. Now, does this say to me, Adaeza, you should totally just buy right now? It's ready to go. No, because this is still a very strong, big, juicy candle. I would not feel comfortable buying right now. All right. Now, I might have bought, like I'm just saying, according to Fibonacci, this might have been that time to get in. It might have been. And you could have made a nice little profit off of that. Trust me, this is way more money than you think. Woo-wee. Way more. I can't even go there, guys. It's like, what the heck? That's a lot. It's like 3,800 pips. It's ridiculous. Okay, within 2 weeks. But I'm just showing you how you could have used Fibonacci. See? Now it's gone lower. It's gone lower. It's gone lower. Oh my God, is this a full-blown retracement? Is Bitcoin dead, guys? Tell me, is Bitcoin, according to market structure, is Bitcoin dead? This is our low, 100%. Is Bitcoin dead? According to market structure, is it dead? Is it dead? Let me know. Tell me if it is dead, dead, dead. It's not dead yet. It really isn't. It's only dead when it breaks this low. Like, that's the sign of it dying. Okay? This is the big move. All of this is just a massive correction. It can still turn around all the way down here. So while a lot of people are freaky outing right now about Bitcoin and feeling some kind of way, this is the best time to be looking for the right snag, if you can, on that coin. Okay? It's dead, Jim. No, it's not. It has not broken the low. Remember, in order for it to be dead, it must not create a high. Check. But it has not broken the low, and it has not made newer lows. It's not dead yet. This is the overall move. This big, juicy move. This is nothing but a correction. It can still turn around. And if you're scared, you're right where the media needs you to be. Understand? It's not done yet. You guys saw it on the other one, how price came all the way down. It retraced to 100% and then still took off. Yes, this is the time that you would be buying it. But the media will have you so scared. Do you guys know the media, it's the media's fault that people bought up here. Because everyone saw this and everyone's like, oh my God, like I don't have to do nothing and I can make millions of dollars. Like, yeah. And they bought on this. People are buying right up here when they should be selling. Now people are afraid to buy right here when they should be, like, they want to sell because they just feel like, oh, it's done. I don't even want nothing to do with this no more. Now people are ready to sell when they should be buying. That is how the market moves. Fear and greed. Greed is what caused this massive movement up and people to buy like it was going out of style, and apparently it did. And fear is what's causing people to sell their stuff when they should be buying it. There you go. Okay, now I want to put a disclaimer out there. Adaeza did not tell you to go out there and buy no Bitcoin. I'm just telling you that this is buying. This is an ideal time to buy, but I'm not telling you to buy. I'm just saying if it was a time to buy, this is a good time. Okay, but you're an adult and you make your own decisions. Just like the people need to know, the coffee is hot, McDonald's. Okay, the coffee is hot. All right, don't drink, it's hot. All right, you guys, I will talk to you on Monday. Hope this was helpful. Okay, guys. Adios.